185,000. Continued claims, which are those that continue to receive benefits after their initial claim, decreased 1,000 to 1.4 million. This is the lowest number on continuing claims since February of 1970. Unemployment claims are extremely low and the labor market remains tight. The unemployment rate is near the pre-COVID low at 3.6% versus 3.5%. But once we start to see the rate increase, it's another early warning signal of a slowdown and a recession to come. Housing bubble fears, same old story that I've been bringing into Money Chat quite a few weeks. Pending home sales, which measures signed contracts on existing homes, fell 1.2% in March, which was stronger than the 1.8% decline expected. Sales are now down 8.2% year over year. There is no doubt that higher interest rates are impacting demand, but this is still very strong considering the increase in prices and the lack of inventory. The media said that this was a washout, but it was only down 1.2% in the face of all of the challenges and better than expectations. A longer time frame view of signed contracts shows that the level of sales is still a strong level, but off the crazy highs that we set after the dip in COVID and the rush to purchase. Redfin released a report stating that homebuyer competition dropped for the first time in 6 months because of the surge in mortgage interest rates and home prices. But they went on to state that most home buyers are still incurring bidding wars, but competition is beginning to cool a bit. I believe now is the best time to buy. There is a hidden opportunity here. The reason is a temporary slowdown in the buyer frenzy. Some buyers have backed out of the market because of the shock in the increase of interest rates, not because they can't afford to buy, but because of the shock factor. The buyer traffic has slowed down a bit, so the crazy multiple offers have also eased up a bit. This is temporary because when the new rates become the new norm, the shock value will wear off and buyers will be back flooding the market. Buy now while buyer traffic is down. Now, there are 407,000 homes for sale at the end of March nationwide, which is up 33% from last year. But of those $407,000 homes, only 35,000 or 9% are actually completed. The rest are either not started or under construction. There is a 6.3 month supply, but when you factor in the homes that you can't move into, it's a half a month of inventory. Where do you go with inflation? The Fed will likely be hiking 50 basis points at May, June, and July meetings. There will also be a meeting in September where they will most likely increase another 50 basis points. After the Fed hike starts to slow down, the economy will take hold. This should also help the U.S. reduce inflation. Overall, I feel that the inflation and the interest rates in turn should start to move lower in October and through the end of the year. Now, there is also a strong chance that the recession is on the horizon, which always causes interest rates to drop sharply. If we look at the history of government spending, 40% of the money printed in the history has been in the last 24 months. That money flowed into rates, stock market, and everything else. We have been running on stimulus money. The recession is coming, and it may be a big one. But a recession is not the same as a depression, which can last for years. Once a recession passes, economic expansion begins again. A recession is a period of temporary economic decline. Now, history of recession, mortgage interest rates decline, and people that own real estate favor well. Mortgage interest rates go down because they are based on the Fannie Mae 30-year bond and how it's trading. When the bond market drops in trading price, mortgage rates increase. When the bond markets increase in trading price, mortgage rates go down. During a recession, investors are putting their money in the bond market as it's a safer place for their money to sit. The return is lower, but the risk is lower. The volatility of the stock market during a recession is not worth the risk for most investors. So why not wait until interest rates go down? The reason why is appreciation. As you wait, you are missing out on appreciation. If you lock in at the high interest rate, you can refinance when the rates go down, but you've locked in that appreciation gain. If you wait, you would have the same interest rates that if you just bought and refinanced. However, you lost that appreciation. And you don't want to not own real estate during a recession. The reason is the same as with an inflation. Real estate is one of the only investments that you have to hedge against inflation. Inflation simply puts that increased cost for goods and services. What cost you $100 yesterday may cost you $105 today to purchase. The value of the dollar is worth less, so that there are more dollars to purchase those same goods and services. Homeowners benefit from inflation because the money that they pay back, their fixed rate mortgage, it is worth less today than it was yesterday, but it's fixed. Everything else is costing you more, but your mortgage, because it's a fixed rate, the higher inflation rate is the sooner that your home will value double value based on the rule of 72. Home prices rise in inflation because as the value of the dollar is worth less due to the higher inflation, it will take more dollars to purchase that same property. Real estate has traditionally worked well as an inflation hedge. Do not miss the hidden opportunity to buy now. And if you don't own real estate, get in now so you have something to hedge against inflation. Tina Mitchell, and that is your Money Chat.